Hi, it's Eric Nuttall of the Ninepoint Energy Strategies. Time for the weekly update. There was a major event down in Houston, CERAWeek, where a lot of oil CEOs and analysts were presenting. And I would say the main theme that emerged were energy realities. For much of this year, much of the past several years, the market has been really impacted sentiment-wise by being told what we've termed as false narratives. And so it was incredibly comforting and satisfying to see a lot of those narratives be debunked. One of which was from the IEA. Fathi Birol, their executive director, for many years now have been talking about how the demand for oil was going to be imminently peaking, how there was no further need for investment in upstream capex, how this is a sunset industry. And that ongoing bearish narrative has been really, really damning to sentiment. It's been fueling a lot of the concerns that I think investors have had about the outlook for hydrocarbons and oil specifically. And so it was encouraging to see Fathi Birol come out and kind of change his tune and talk about how there is absolutely a need for further investment in oil and natural gas, etc. OPEC put out a good piece yesterday too, kind of going through the historical background of some of the commentaries versus what we're seeing now. As well, there was a very, very important interview that Brian Sullivan had with Brian Sheffield, the former CEO of Pioneer Natural Resources that sold to Exxon. Pioneer at the time was believed to have the deepest shale inventory. At the time, our numbers using guidance was roughly 17 years of stay flat inventory. And in this interview, it was intriguing. Brian Sheffield came out and said that Pioneer, the reason why they sold was they were actually running out of inventory. And he went on to say that the industry is, in fact, running out of inventory. They said that they have enough tier one, I think, till 2028, which is only 3 years for now. Another executive, Harold Hamm, who is a shale luminary, founder of Continental Resources in the Bakken play, talked about how U.S. oil production is entering a plateau. And the CEO of Occidental went on to say that U.S. production will be peaking within the next 5 years. And so this all supports our contention that U.S. shale has entered its twilight. This is a massively, massively important development for the oil market and is widely underappreciated. It goes in stark contrast to the narrative of drill, baby, drill, U.S. energy independence, they don't need Canadian oil. That is all a fantasy. And yet it continues to impact the sentiment and the desire to invest in energy equities, leading to depressed valuations. We continue to believe, and now we are joined increasingly by shale executives, shale luminaries themselves, in that the best days of shale are behind us. Mother Nature, geology, constraints on spending will always overrule the White House and their desire to get a low oil price. And so when the energy secretary, for example, down at CERAWeek was talking about how the White House wants $50 and shale companies will still drill, and for some reason they'll want to add production to crash the oil price, like it just makes no sense. So drill, baby, drill, banish the saying from your mind. Believe not what you hear, but believe what you see. The twilight of shale is upon us. U.S. shale grew at its slowest pace last year since its inception, outside of COVID. When we look at company guidance, Rystad was showing that company guidance points to about 125,000 barrels per day of growth this year of black oil. So that's roughly a third of what it grew last year. And so while U.S. shale may not be peaking this year, it may be, it may not be. The best days are behind us. The rate of growth is lower and lower and lower, leading to not only the peak of U.S. production, but the peaking in non-OPEC supply. And so it is massively important. What we see ahead in the next couple of years is a call on OPEC, which they will not be able to answer. OPEC's spare capacity will have been normalized by that point. The demand for oil will continue to grow for many, many years to come. And ultimately, the price of oil will have to act as a demand-destructive mechanism. We were there a couple of years ago. The call, we were early. We now see the stars aligning and that play coming to fruition. With that said, we continue to use $70 oil as our base case for energy equities this year. The absorption of OPEC spare capacity is a necessity. It is, I think right now, sentiment is challenging oil price where We think the oil price is roughly $16 under fair value, but that's being impacted by sentiment. And so one of the biggest drivers of negative sentiment, one is drill baby drill. The second is this notion, well, oh my God, it doesn't really matter because OPEC has all this spare capacity. And so we have to begin the path of normalization of that said capacity. RBC put out a really good report. They said if you account for the cheating that has been ongoing by several of the members of the voluntary deal within OPEC Plus, the real amount of production to be brought onto the market over the next 18 months is only about 900,000 barrels per day. Not the headline of 2.6, I think is the official number. And so that is roughly 1 year of demand growth over the next 18 months at a time when U.S. shale growth is massively decelerating and the peak of not just U.S. but non-OPEC is in a couple of years' time. So we remain very bullish on the outlook for oil in 2026 and beyond. Using $70 oil, we continue to be able to buy companies trading at 12, 13, 14, 19% free cash flow yields, largely because sentiment remains challenged around the two false narratives of drill baby drill and OPEC spare capacity, plus the ongoing confusion and uncertainty around tariffs. We continue to believe that tariffs will not be applied on Canadian oil for reasons which we spent a lot of time on it in the past. I won't bore you with those now. Even if we're wrong, we see cash flow being impacted by only a couple percent. And given the sell-off in oil equities, we think it's more than discounted. We saw M&A in Canada, one of our major holdings being acquired by another company. I think it validates our view that depressed valuations, if the market does not recognize it, meaning if investors don't recognize it enough to bid up stocks, the industry will take care of the valuation problem. And so with that, we look forward to next week's update. Thanks for your time.